All right, guys, this is Paul Singh, the Market Speculator, with day 4 of the Swing Trading Mastery Challenge. And today we're going to talk about managing risk and specifically stop placement. So what I'm going to do is when we talk about managing risk, instead of just doing it all in one day, I've broken it down into 4 days because each of these specific things are so important. And on the 4th day, we put it all together. So today we're going to talk about stop placement. That's managing your downside risk. And then tomorrow, we're going to talk about stop placement on a macro level because most people think about managing risk just for the specific trade you're taking. And the mistake people make is they don't think about it in the larger context of your overall account. So today we're going to take the specific, the micro, and talk about stop placement for a trade you're in. Tomorrow we're going to talk about not stop placement, but managing risk on a macro level, your entire account. On day 6, then we're going to talk about the reward or the target and how that relates to your stop placement. And then finally, on the last day, we're going to put it all together with the reward to risk ratio. So there are a lot of factors that go into a successful trade or managing your risk properly. And this is really important. I think it's the most important thing you do as a trader. There's all these other things we test and analyze. But really, when it comes down to it, if you are managing your risk well, you almost can't lose, or at least you can't lose big. Maybe you'll lose a little bit, but you're protecting your account. And let's say you start with 100,000, you know you're not going to really lose too much, or whatever size it is, even at 10,000, you're probably not going to go below 9 if you use proper risk management. So this is the starting point. So that's what we're going to talk about today. We're going to go back to Netflix, and over the next few days, we're going to use Netflix as our example for how we're managing our risk. So I'm going to go ahead and share my screen. And while I do that, let's talk a little about, one second here. Okay, so you should be seeing Netflix up here. And let's talk a little about how we effectively are setting our stops. So what we need to think about are essentially 3 different things. One, what is the maximum we're willing to lose on a trade? And that's what a stop is. That's what risk management is. It's protecting your downside capital. And your capital is the most important thing. It's the lifeblood of a trader. You need capital. So it's kind of a catch-22. And then what you're trading is also what you need to be a successful trader. You need that trading capital. So how do we protect that? What's the maximum we're willing to lose on a specific trade? Then we need to see within the chart, where does it make sense to place our stop? And that's a mistake a lot of traders will make. They just say to themselves, okay, I can only risk $1,000 on this trade, so my stop has to be at this spot. Well, if it doesn't make sense on the chart, you're probably just going to be stopped out. So it needs to make sense within where support, resistance, where different buying and selling levels are on the chart. We'll talk about that in a second. And then finally, the position sizing needs to make sense. If you do all that, you figure out what your position size would end up being. If that doesn't give you the reward you need for a trade on a macro level for your account, it's a waste of your time. So these are the 3 things I always think about before entering a trade. It's the first thing I do. Before we think about target, we always start with the stop. It's kind of like defense before offense. And we really need to protect ourselves. So let's take a look at Netflix. Let's just say when I was typing this a few minutes ago, Netflix was at 367. It's down to 366.40. Let's just say it's at 367. So we're entering Netflix at 367. Now, where do we place our stop within the context of the chart? Let's take a look at the chart here. There's a couple of things to think about. One, if we place it anywhere below the 9, above the 9, there's a good chance we're going to get stopped out because as you can see on the chart here, we often get tests of the 9. So we want to at least be able to place it at 353.71. You can see over here that little box is telling us where the 9 EMA is. That's 353.72. We talked about moving averages yesterday, so you know why now that moving averages are so critical. And if you haven't done that yet, go back to that lesson. It's a day 3 lesson and do the exercise as well. Now, we could go all the way down to 50-day moving average, but that would be way too loose of a stop, and we couldn't get the position size we need to make some money on this trade. So I would say under the moving average is an important level, and also this price action in here. There was a lot of buying and selling going on in these days here where it consolidated. Look at all that volume coming in. We're going to talk about these concepts a little later, but these are important levels here. So we want to be under this range, which gets us at about 347, and that's the spot I used in our example in the lesson. So we're going to place our stop at 347. We're entering at 367, meaning we're risking 20 points or $20. Now, let's assume right now that we have a $100,000 account. And it doesn't matter if you trade a $5,000 or $1 million account. For now, we're saying we're trading a $100,000 account. I generally don't want to risk more than 1% of the account on the trade. We'll talk about that more tomorrow when we get into protecting your account on a macro level. But just today, let's assume it's 1%. So 1% of 100,000 is 1,000. We are willing to lose $1,000 on this trade. So that means if we're risking 20 points and the price is at 367, we're at 347 here. That means we can enter 50 shares. 50 times 20 is 1,000. So we can essentially take 50 shares of this stock. Now we have to think about that position size. Is it enough to make us any money? Now we're going to talk about rewards in a few days, but I'll jump to it right now. The way I would analyze where I'm going to take my reward on this, I would look at the past history of the stock because we don't have a resistance level here to really guide us. But this stock has shown it can move 30, 40, 50 points. And since we're risking 20 here, and we know this thing could move potentially up to 400, 410 maybe, that we could get 40 points on this. And if we did that, our $1,000 risk would be a $2,000 reward, which is a good position size for us. $2,000 reward is good when we're only risking 1,000. Again, these concepts, I'm kind of jumping down the line now, but these concepts we're going to talk about in the next few days. But essentially, we can take this position size. So we could take this trade. So that's an example of how we're setting our stop. So our stop is going to be placed under the 9, under this range here at 347. That's about a 20-point risk here. We're taking 50 shares. We're risking $1,000. That is the way we're analyzing our risk here. I have a $100,000 account, losing $1,000. While I wouldn't want to do that, I'm comfortable with that. It's not going to kill me to go from 100,000 to 99. Now, what happens if I took 1,000 shares here, and now all of a sudden I couldn't even risk that much. But let's say I took 500 shares. I'd be risking way too much for my account size. That would be painful if I lost that much. And too many traders do that. They get greedy. They don't think about how a loss could impact their account, and they risk way too much. So we're going to risk 1%. We're going to take a 50 share position, risk $1,000. If we lose, so what? We're at 99,000. We can still make a lot of trades before it really impacts our account. So the exercise that you're going to do now for tomorrow is you're going to pretend you entered on this day here. Now, this was a pullback setup. We talked about moving averages last time. We remount the 50-day moving average. We'll talk about this setup later in the challenge, but just assume you're entering on the close of 4/4/2018, April 4th, at 288.94. So what I want you to do here is to decide where you're going to place your stop and what your position size is going to be. So that is your homework for tomorrow. You can do this with other stocks as well. Pull up Google, pull up Amazon, take different spots on this stock. Pretend you entered at different levels and where your stop should have been placed for that entry.